The stock market's definitely going to crash. How do we know this? Because it's done it before.
People were making fortunes on the stock market, and then all of a sudden, poof.
The market took a severe dip. They called it the Babson break.
There's an old saying on Wall Street that the two most important emotions are fear and greed. And you go from fear to greed in about a fraction of a second.
Never going to go down. The market will just keep going up and up and up.
The market went down and down and down.
Well, Apple shares are just getting hammered this morning.
We're down by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate.
They know the market is toast. They know the stock market is finished. The euro, as far as they're concerned, they don't really care.
You dream about the economy at night?
I try not to.
Yeah.
Nightmare.
Be prepared and act now.
Well, he was a cheery sort, wasn't he? But he kind of has a point. Research by Edward Yardney's company, Yardney Research, found that the S&P 500 has experienced a decline of at least 10% 38 times since 1950. Averaged out, that's a crash every 1.87 years. The last crash we had was in March 2020.
Stocks, they fell hard again today. Economic fears and many unknowns rattling investors.
So based on that average, we're about 3 months away from being overdue a correction. But the markets don't tend to care about averages. I mean, if it was that easy, everyone would just sell out every 1.8 years and then buy back in at the bottom of the market.
My strategy in a nutshell. I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
When you are new to investing, which I know a lot of you are, the prospect of a market crash can seem like a terrifying thing.
I'm scared to close my eyes. I'm scared to open them.
You've been chilling in the green ever since you got on the investing train, and the idea of your portfolio being slapped by 20% terrifies you. Add to the fact that YouTube is full of creators saying that everything is going to be the catalyst for the next market crash, because let's face it, corrections and crashes command clicks.
Naughty, naughty, you teasing me.
First of all, let's be crystal clear, the stock market will crash again. You can count on corrections in stock market prices like you can count on Kerry Katona going bankrupt again. The problem is, it's impossible to predict when it will happen and what asset classes it will affect. So the only choice we have as investors is
Be prepared and act now.
There's a million quotes on preparation that I could use here to emphasise my point. But I think in this context, the one I like the best is from Hall of Fame racing driver Bobby Unser, who said, "Success is where preparation and opportunity meet." The opportunity here is the ever on the horizon market crash. And with a few simple steps, we can turn this into a success. So let's get prepared, shall we? Let's start by acknowledging that preparation in this sense means preparing yourself for the downturn, and not preparing your portfolio so that it is immune to the decline in the market. When we talk about a decline in the stock market, people's instant reaction tends to be, oh, well, I'll just move some stocks into gold, or I'll increase my allocation of bonds so that will protect me from the downturn. There is a school of thought within investing that looks to build a defensive portfolio that can weather the short-term storms. Restructuring a portfolio to navigate through an overall market downturn is incredibly hard, because we don't know what will be affected or when. Morningstar did an excellent study on diversifying and how it has changed. I'll link it below, but here are a couple of takeaways. On screen now is a very colourful chart. That kind of reminds me of a book about a patchwork elephant called Elmer. But anyway, the confusing colours of this graph serves to demonstrate a point. On the right here, you can see each colour represents a different asset class or investment you could hold. So as an example, emerging markets are in this sort of purpley pink colour. We can see that between 2005 and 2007, emerging markets smashed it. And then, minus 53%. What this table essentially shows is that the asset class that performs best each year is almost completely random and anyone's guess. So picking out asset classes to invest in on the basis that you think there might be a market downturn is an incredibly hard thing to do. Furthermore, this chart shows the percentage of drops of a few asset classes in every major market downturn since the year 2000. Notice how if you were invested in 2000 and saw that collapse, you might have gone into the next crash thinking that REITs are a great way to protect your portfolio, but you would have been wrong. The table does show though that the treasury bonds have performed well as a hedge and so has gold, but that does not mean that it always will. There's an argument to suggest that the low interest rate environment will mean that bonds won't perform as effectively as hedges going forwards. This is why I don't chop around my asset allocation when I think a market crash is coming, because at the end of the day, trying to predict when a market crash will happen is market timing, and that's notoriously hard to do. So how are we meant to prepare for a market crash?
Michael always has a plan B.
This is as powerful as a shotgun. Really try to take out one of these targets.
A throwing stick.
First thing you need to do is assess your exposure. If anyone can actually remember going on holiday, one of the traditions that really signifies you're off on your jollies is that little safety dance the air hostesses do prior to takeoff. You know the one, exits are here, here and here, life belts under your seat, let your kids suffocate while you put your mask on first, and as part of that, we're taught to brace. The There's actually a lot of traction behind a rumour online that the brace position is actually designed just to protect your teeth, so that when the plane crashes they can identify the bodies. There's also the theory that it's designed to give you like a quick death. In reality, it's been proven that the brace position saves lives as it reduces secondary impact from human arms and legs flailing about. It does not stop the crash, it just prepares you for it. Assessing your exposure in the good times can help you brace for the bad ones. The table on screen shows data around bear markets, a time in which asset prices decline. The key bit I want us to look at is the bottom section that shows the amount the S&P 500 dropped from top to bottom in that bear market. We can see the worst declines from the top of the market to the bottom were in the region of 50 to 60%. And that average decrease is 33%. Now what I want you to do is take the current value of your portfolio, all of your investments, and I want you to divide it in two. I want you to stare at that number and answer me an honest question. Could you stomach that kind of drop for a prolonged period of time? Call it 2 years. If you woke up every day, looked at your portfolio and you saw that it had halved in value to that level, could you stomach it? Are you braced for that kind of drop? If the idea of your portfolio being chopped by 30 to 50% makes you feel sick, you may be inclined to reduce your exposure to high-risk assets overall. And for the rest of us, get used to staring at that number and realise that when the plane comes down, it's probably going to take everything else with it. Assets nowadays are quite heavily correlated, so you'll probably find if there is a massive market downturn within the stock market, that things like your cryptocurrencies and all your other assets will drop in value as well. You'll likely be staring at heavy losses across your whole portfolio. The thing we need to realise here is that the state of our investments are a reflection of real-world events with real-world implications. The onset of the pandemic in 2020 caused asset classes worldwide to slide.
The worst sell-off on Wall Street since the financial crisis in 2008.
But it also led to millions of people struggling financially. Share prices don't operate in an isolated bubble. They're a reflection of real-world events, of things that are going on in our day-to-day lives. Which brings me on to point number 2. Get your finances in order so you can weather the storm. Effectively navigating a crash in the stock market is dictated by your own ability to choose how you react. It's those of us that are forced to sell that will suffer the most. It's those of us that are forced to lock in or crystallise those losses that are going to really feel the pain. But if the crash in share prices is being underpinned or caused by an economic downturn, then it stands to reason that people might be losing their jobs or even just not be earning as much money as they were a few months ago. If you have to sell your investments to put food on the table, you're going to be feeling it a lot more than others. No one is immune from losing their main source of income, and the reality of it is that it's most likely to happen when the global economy is having a bad time. While things are going good, take this time to reduce expensive debts. I'm not talking mortgages or student loans, I mean credit cards or bank loans, even car finance potentially. Also, take the time to build up an emergency fund. At least 3 months worth of living costs, but in reality, I would look for 6 to 12 months personally. Lower outgoings and a large pot of cash on hand are essential for being able to chill out when the world around you seems to be falling apart. And then add to this point 3, which is have a plan. Success is where opportunity meets preparation, and that preparation needs to happen ahead of time. Here's what I did in March 2020 that meant that I was prepared and fared pretty well through that period of time. First of all, I had a list of companies I wished to buy if there was ever an overall decline in share prices. These were businesses and funds that I thought were relatively safe, had good long-term prospects, and basically could shake off any recession pretty quickly. There's nothing worse than seeing everything fall in price and just not knowing what to buy. A couple of examples of such companies would be like Coca-Cola, Disney or Google, but mainly it was my index funds, my world fund or say an S&P 500. If you're an index fund investor, you should be consistently investing every month regardless what the market is doing. So a 20 or 30% downturn in the market shouldn't really faze you at all. But having a plan, having something that you can stick to when the markets do tank, removes that human emotion element. My plan was pretty simple. If there's an overall drop in world markets as a result of an external factor that leads to a decrease in global asset values of more than 10%, I move from buying consistently on a monthly basis to buying either weekly or daily. The quicker the market drops, the more regular I'm buying in. In March, I was buying in every single day. I used my emergency funds and I even cancelled buying a house so I could drop more money into the market. Investing about 1% of the funds that I had every single day because I knew that I was never going to call the bottom of the market, but I could buy it all the way down and all the way back up again. Now I must caveat that investing in your emergency fund goes against what they are there for. But I was able to do this confidently as I knew that my job would remain unscathed as a result of the pandemic. The key is not sitting on the sidelines panicking and not going too hard at the start of the decline. You don't want to be buying into the market at a price and it continues to slide and you have no money left to take advantage of it. It will go against every fibre in your being to buy the dip, but you need to be reminding yourself that historically markets have recovered and this is why we think long term. If I sat down with you now and said, how long are you going to be investing for? I'd hope you'd say, well, Damien, I plan to invest for the rest of my life. Well, if that is the case, and we know that downturns or crashes in the market are a feature that have played out time and time again, why would this crash be any different? Why is that going to stop you from investing long term? Is this the end of the world? Is what is going on about to make investing in low-cost index funds long term irrelevant? If the answer to those questions is no, then an unforeseen drop in the stock market shouldn't be cause to panic. It should be seen as an opportunity and just part of the ride. Have a plan, have a pot of cash so you can take advantage of the drop, but most of all,
Be prepared.
Everywhere I go, the people really want to know who I is and who I be. They stop and stare when they see me.